Okay, now let's move on. So in this section, I want to discuss about risk management for stock trading. Alright, this is an important concept. Doesn't matter whether you're trading stocks, forex, futures, bonds, or whatsoever. Risk management is paramount for a trader or a speculator or whatever. It's paramount. And let me explain to you, why risk management is so important, right? Because you can have a profitable trading system that makes money, otherwise known as an edge. But if you do not have proper risk management, doesn't matter, you're still going to blow up your trading account. And let me prove it to you. So let's assume, right, that there is this trading system, right? It wins 50% of the time with an average of a 1 to 2 risk-reward ratio. What does risk-reward ratio means is that for every dollar that you risk, right, in the long run, on average, right, you will get back $2 in profit. So if let's say you risk $100, right, your profit, right, in the long run, is $200. So that's a risk-reward ratio of a 1 to 2, meaning that, for every dollar you risk, you get back $2, in short. And let's say that there are two traders, right, John and Sally. John is an aggressive trader, he's go big or go home kind of trader, and he risks 50% of his account on each trade. Whereas Sally, she's more conservative and she only risks 1% of her account on each trade. So let's say, they both have, let's say, to keep things simple, a 100k account. So what this means is that John, right, whenever he put on a trade, right, he would put 50% of this amount, which is $50,000, at risk for each trade. Means if the trade hits his stop loss, he's down $50,000. Whereas Sally, she risks 1% of her account on each trade. So this means 1% of 100k, which is $1,000. So this means if a trade hits Sally's stop loss, right, she loses $1,000. And let's say hypothetically, right, the next 10 trades, the outcome are this outcome: lose, 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 win, win, lose, lose, win, win, win. So it's again, half of them are losers, half of them are winners. And now John, since he risked 50% of his account on each trade, you can see that over here lose and lose, right? By here he has essentially wiped out on the second trade because he risked 50% of his account on each trade. So let's just give John a big fat X. So sorry to all the Johns out there, nothing against you, just a common name that I decided to go with. How about Sally? Okay, so Sally, let's have a look, right? So lose, 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 right? So it's minus 1%, minus 1%, minus 1%. Win, win, right? So again, when she wins, right, she gets an average of a 1 to 2 risk-reward ratio. So if she wins, she makes 2 times her initial risk. So it is positive 2% plus 2, plus 2. Again here, minus 1, minus 1, minus 1, minus 1. Then win, 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 right? So let's do it here. Plus 2, plus 2, plus 2. So as for Sally, right, what is the net outcome for her? What's the net profit that she made? Well, if you calculate it, right, you know that she is up a positive return of 5%. And compare that with John, who blew up his trading account, you can see that clearly, right? Having a profitable trading system is not the only part of the equation. You still must take into account your risk management, because as I've just shared with you, a profitable trading system without proper risk management will still cause you to lose in the long run. So risk management is paramount. And in this case, right, Sally, who risked 1% risk on each trade, right, end up, making a positive return over time. So now the question is, how do you, put on your trades such that if the trade hits your stop loss, you lose not more than 1% of your trading account? How would you do that? Okay, so I'm going to show you how to do it. It's very simple. This is a spreadsheet that I developed myself. You can just Google stock trading position sizing calculator, and you probably can find something similar. So what you'll do is that again, most of these calculators perform in the same way. You just put in what is your capital. So let's assume with 100k. Okay, and your risk is 1%. Okay, let's say you want to buy a stock, and you will identify what is the entry price that you're going to buy the stock. At what price will you buy? So let's say we keep things simple. You buy it at $100, and let's say at the stop, right, your stop loss, right, for the trade is at $80. So what this will do is that you will see that this value over here is the risk dollar. This simply is a function of this 1% the 1% of 100,000. This gives you $1,000 over here. How about the number of shares? There is 50. How do you get this value of 50? Again, very simple. You just take this $1,000 divide by $20. Why $20? Because that's the difference between your buy price and your stop loss level. Alright, I repeat, right? The difference between your entry price and your stop loss level, that is $20. So you take your risk amount, right, the notional amount, divide by this $20, it gives you the number of shares, which is 50. Okay, and what this means is that if you put on a trade, set your buy point at $100, stop loss at $80, you buy 50 shares, you put in the 50 number of shares, and if the trade hits your stop loss, you will lose $1,000 on that trade, which is equivalent to the 1% risk of your initial capital. Okay, so there's a couple of things that I want to point out, right? So your number of shares that you buy, it's never fixed. Yeah, it's dependent on a couple of things. Number one, the tighter your stop loss, right? Meaning, let's say now instead of $80 stop loss, we have a $90 stop loss. So this means your buy price and your stop loss level now is only $10. So the tighter your stop loss, right, the higher the number of shares you can buy, while you still keep your risk constant. Okay, and likewise, if you increase the size of your stop loss, let's say now it's $50. Notice that you only can buy 20 shares at this point in time. Okay, so the number of shares that you buy is a function of the size of your stop loss. The wider it is, the lesser the number of shares you can buy. The tighter it is, right, the more the number of shares that you can buy, right, and still while keeping your risk constant over here. Needless to say, right, if you increase your risk amount, if you risk like John, 50%, right, you can buy more shares, right? But at the same time, right, you risk losing 50% of your account in this case. Okay, so this is just a very simple stock position sizing calculator. You can Google it. All right, and I've just pretty much shared with you the formula and how it works, right? Play around with the figures, right, and you pretty much understand, right, how risk management works in stocks. Okay, so with that said, let's do a quick recap, shall we? My suggestion is, again, right, if you are getting involved in trading, right, try not to risk more than 1% of your trading capital, as per the example I just shared with you earlier, right? So most traders are usually between the realm of 1-2%, but I would say just stick with 1%. If you can risk smaller, like 0.5%, go ahead, right? Because the smaller your losses, right, the lesser you pay in tuition fees, right, to the market. Second thing to note is that the tighter your stop loss, right, the larger you can put on your position size, the more the number of shares you can buy while still keeping your risk constant. And then finally, right, the larger your stop loss, right, the smaller the number of shares that you must buy, right, to keep your risk constant. Okay, so with that said, right, I'll see you in the next section.